Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us again here at Ausbiz. Let's get across what happened overnight. Global stocks rallying, boosted by the prospect of lower interest rates in the States. On Wall Street, the major indices saw their biggest gains in more than 2 months, following the previous session's heavy sell-off prompted by a weaker than expected jobs data. Nvidia and Meta were the biggest boosts to the broader markets, along with Alphabet and Netflix. Tesla shares rose after the EV maker granted Chief Executive Elon Musk 96 million shares worth about $29 billion. Spotify gained as the music streaming platform announced plans to raise the monthly price of its premium subscription in select markets from September. Joby Aviation shares soared after the company said it will acquire helicopter ride-sharing company Blade Air Mobility's passenger business for up to $125 million. Blade shares also soaring. And Class A shares of Warren Buffett's Berkshire Hathaway fell following a $3.8 billion write-down and a dip in quarterly operating profit. Palantir Technologies raised its annual revenue forecast for the second time this year, expecting robust demand for its AI-linked services from businesses and governments, sending its shares up 5% in extended trade. And Swiss luxury watchmakers shares, including Richemont and Swatch, fell in the wake of the 39% US tariff imposed on Swiss goods. Well, President Trump has warned he will substantially raise tariffs on goods from India because it continues to purchase Russian oil. India has said it will take measures to safeguard its interests and called its targeting by the US president unjustified. Meanwhile, Switzerland has said it's ready to make a more attractive offer in trade talks with Washington, following a crisis meeting aimed at averting a 39% US tariff on its exports. And in the latest US data, factory orders in June fell 4.8% as forecast, with durable goods orders down 9.4%. Meanwhile, San Francisco Fed President Mary Daly has said evidence of a softening US jobs market and no signs of persistent tariff-driven inflation means the time is nearing for interest rate cuts, saying, "I was willing to wait another cycle, but I can't wait forever." Well, US Treasury yields were slightly lower in choppy trade. The 10-year at 4.2%, the 2-year close to 3.7%. And the US dollar has recovered slightly, rising 0.5% against the Swiss franc. The Aussie is trading at 64.7 US cents. And Bitcoin is lower, trading at around 115,000 US dollars. Oil prices have fallen to their lowest level in a week after OPEC Plus agreed to another large output increase in September, adding to oversupply concerns after US data showed lackluster fuel demand. Brent crude futures down 1.3% at $68 a barrel. Copper was up 0.5%, iron ore rising 1.4% to $100 a tonne. And gold rose for a third straight session after last week's US jobs data fueled expectations of interest rate cuts by the Fed Reserve. Spot gold up to $3,372 an ounce. Let's get across what we're seeing on Wall Street at the moment. Steve Sosnick is joining us from Interactive Brokers. Steve, welcome back. So, interesting, we saw that sharp sell-off on Friday. That all reversed in the session just gone. That FOMO, MOMO, what's taking the market higher at the moment?
Good morning, Andrew. Yeah, I think you pretty much summed up the two basic reasons. The market pretty much called Friday a mulligan. I mean, we basically got back everything we lost on Friday, despite the fact that the bond market, the currency markets, the commodity markets, pretty much every other market decided that the numbers that occurred on Friday were pretty much, were things were pretty much the same for them today. But somehow stocks decided that everything was fine and we should just revert to where we're going to. So we have to then think of what the rationale for that might be. And that is, the only explanation I can come up with is that the ongoing desire, the ongoing confidence for investors to buy dips and then chase the rallies, which is basically MOMO and FOMO, or vice versa, took us back to where we were on Friday without seeing any evidence of why that would be the case from fundamentals.
Well, I mean, what are you seeing with the US economy at the moment, Steve? I mean, is the jobs market significantly weaker as you see it?
I suppose so. I mean, there were some technical factors in it, because everybody was been asking the question, how did they get it so wrong? And basically, there's two surveys that go on. There's a business survey and a household survey. The household survey does the unemployment rates. The business survey does the hiring rates. And from what I've heard anecdotally, or what I've read from respected economists, is that the response rate on these surveys has gotten worse and worse, to the point where about only 60% of the businesses respond. So it's entirely possible that the businesses that were hiring sent back their forms and the businesses that were firing didn't in any sort of timely manner. And that's how you get the revision. Problem is, the last revision of this size, the last one that was bigger, was in 2009, which we remember as the global financial crisis. So that's not a great sign. Certainly the numbers you said about durable goods and stuff, those, they came in about in line, but sharply lower. The market's still going to have to reckon with the full effect of tariffs. Service prices have been sticky. So there's a lot of factors going on here, none of which are all that positive for the economy. So the market, I guess, is the stock market's decided that, we'll get rate cuts. That's good. All the markets have decided that rate cuts are far more likely today than they were on Friday, and understandably so. But only the stock market is the one that said, yippee. My contention, I should say, has always been careful what you wish for in the way of rate cuts, because if they're doing it because circumstances are benign and you can cut rates, that's great. If they're cutting rates because things are horrible, that's a problem. And I think we're sort of teetering on that. We're not there yet, but those labor numbers definitely are cause for concern.
Well, Steve, it was unfortunate timing, wasn't it, for the Fed, given this came out a day or two after the meeting. So, I mean, the market, the president clearly telling the Fed, you've got to cut now.
He's been saying that all along, though. So, I mean, I think I think the market really didn't respond to that one, because he said it. He said it on Wednesday and Thursday as well. And, and on those days, we had basically a 40% probability priced in, we being the Fed funds futures. We're pricing at about a 40% probability of a rate cut. And he said it after the numbers came out. And even after, of course, he fired the head of the Bureau of Labor Statistics, which is not, that's pretty much uncharted territory for the U.S. for the president to intervene in that way. But so the market came to its own decisions. The market decided this was what it wanted to do, and it did it in terms of pricing in more rate cuts. I think the question you get into here is that the rate cuts, again, the labor market is sort of pointing that way. And, I'd literally written a piece on Thursday as a recap of what happened at the Fed on Wednesday, saying, Powell seems willing to wait because the dual mandate doesn't require it. The labor market, to the best anybody knew at that point, had been reasonably healthy. And inflation was more benign than it was, but not necessarily compellingly out of the woods in a way that could give the Fed confidence to cut without, for that benign scenario. Now, just 24 hours later, I had to eat crow because I was agreeing with Powell's assessment. But then, when the facts change, my opinion has to change. That's what John Maynard Keynes famously said. It's something to that effect.
Yeah.
And so that's where we find ourselves.
So, meanwhile, Steve, what are you seeing with earnings at the moment? In fact, what have we got coming up? Caterpillar, which is going to be something of a barometer, I guess, to where the economy is tracking. But moreover, what have you seen with those earnings results, particularly over the past week? And what is ahead in terms of their guidance?
Well, that's, it's interesting. In some ways, I did some preliminary stuff. I haven't been able to update the figures today. I'd hoped to get it done. I just couldn't because there was so many earnings last week. But the preliminary numbers I ran last week were basically indicating that the bigger the company, the higher the expectations, thus the higher the bar it was for them to beat earnings. So a lot of this, of the S&P 500, a lot of the smaller companies, did fine because the market wasn't anticipating too much, and so the numbers came in and they were pretty good. There was a little more trouble, with the exception, of course, of Microsoft and Meta. A little more trouble when the companies got a bit bigger because there'd been some big numbers priced in. So think about, let's say, Alphabet, Google, where the numbers beat on pretty much every metric and the stock went up 1%. Whereas at the same time, other stocks definitely got hit much harder. I think of Tesla, which got clobbered the same day. In the case of Amazon and Apple, Amazon did pretty poorly despite looking good on the top line, whereas Apple, beat in some ways and wasn't really rewarded too well. So I think that's going to be the key. I'm looking a lot toward Disney, actually, which is going to be interesting because there's all sorts of anecdotal evidence, again, that travel is way down. Disney, of course, the parks benefit tremendously from travel. There's concerns about discretionary income, discretionary spending. So as we're not yet in the point where most of the retailers report, but I'm going to start to look for more consumer discretionary type of companies and retailers to see if the consumer, is participating in this economy, because otherwise we start talking about, a K-shaped economy where the people at the top end do well, the people in the middle or down do not. And that's a very tricky situation to navigate.
Steve, great to get across what you are seeing on US markets. Thanks for joining us from Interactive Brokers.
Thank you so much, Andrew. We'll talk again soon.
Checking locally, just ahead of the open, we are expecting a very positive session. As you can see, we're up 1% on SPI futures. And we're going to get right across that in just a couple of minutes. Join us then.